Marty, thank you very much. On the issue of leverage, that really cuts to what I think is the fly in the ointment. I think the real risk to the economy and capital markets globally is inflation. I think that we're all subject to market memory and only remember the last few years. I graduated from Duke University, where I studied economics in 1983, and in the 1970s, the Fed failed to address inflation for about 6 or 7 years until they had to bring in Paul Volcker. I think we're in a very similar situation because in the 70s, there was an oil crisis. We now have an energy crisis. And I think that where people are looking for inflation to moderate and things to stabilize, I think the risk is on the downside. And that is a key factor that I'm going to address in my presentation now. I'm going to share my screen so you can see our presentation. And I'm going to be joined by Richard Gula. And Richard is a guy who's brilliant. He went to Harvard undergrad, worked for some of the biggest names on Wall Street. He set up the chart room at Fidelity. And when you think about that, for one of the largest asset managers in the world in the 1990s, he put together all the technical indicators they were looking at, and he will highlight in some slides at the end what market risk he's observing and what we should all be tracking. Can everyone see my screen that says
Yeah, it looks great.
Cycle? Yes?
Yes.
So that's it. And I think that in terms of current market risk, I think that we have downside risk per farrel of 30% in this S&P move, and we're down 18%. Jeremy Grantham would say that it's 50%. He has a great deal of experience, and I think that simply brings us back to long-term trends. And frankly, if inflation's out of control, it could be worse. So real quick, this is the Nasdaq down 26, S&P down 18, the Dow 2 days ago. I think that I wanted to bring everyone's attention to, first, we had a major break in the S&P off the 2020, March 2020 lows back in January. But something interesting happened in May, and we had an inflation print of 8.6. And I think there was this expectation that inflation would moderate, and suddenly everyone got very worried. And the Fed acted very quickly to then raise 3/4, and we'll do that again in July. But I think what happened is the perception was suddenly the Fed isn't in control. And during 8 days in June, the S&P declined 13%, which is quite sharp. Now, I like to look at things in terms of evaluation, and the Fed risk premium model is very good. And I've looked at it at major tops, and I think that that's what we have to be looking at this current situation as. And that would be similar to the 2000 peak and the 2008 peak. So in this situation, what you have is earnings start to roll over, and that caused a big decline in 2000, and then similarly in 2008. Right now, the market has come down, but earnings have yet to roll over. And so July ought to be very interesting as earnings are announced. One of the most interesting charts I had come across was this, where we look at cycles, calling them inflationary and deflationary. And you take a look at the S&P to divide by the log of the PPI, and you get very nice segments. And we are all familiar with the 1970s being an inflationary period. But then again, from 2000 to 2008 was an inflationary period. It wasn't significant, but people will remember that oil prices rose significantly during that period. And they may remember $5 gas. But then, of course, that later reversed. We were in a deflationary period where the FANGs and the triple Q long duration assets took off. It is our view that right now we have flipped back into an inflationary period. And I would point to history that those inflationary periods typically run about 10 years. So looking for a quick resolution to inflation, I think, is naive. But I thought it was naive for the Fed to talk about transitory inflation a year ago. Now, This is a chart off of Schiller's work, and basically stocks and bonds, in my opinion, are very overvalued, and relative to history, they're very expensive. Bonds yields have been declining since 1981. Now they're moving back up, but people forget that they were at 15%. I wouldn't be surprised if we saw 4, 5, or 6% in interest rates. The equity market is at a 28 PE based upon Schiller's CAPE ratio, and that is in the same range as the major bubbles in 2000, in 1901, 1929, 68, 2000. And for that reason, both stocks and bonds historically are very expensive. And I think, again, this idea of transitory, I just pulled this off of the St. Louis, the Bureau of Labor Statistics. When you look at last month, energy was up 35%. Food was up almost 10%. I just saw that the Farm Bureau put out something saying 4th of July picnic is going to be up 17%. Sam Zell and Larry Summers both said, you know, these CPI numbers are actually inaccurate. So that 17% number about the cost of 4th of July might be actually more accurate. So in terms of an investment philosophy that we do, we see that positioning for an inflationary environment is your best defense against significant asset decline. And it also represents a significant opportunity to make money. I think that the big issue here is when you think about financial modeling, people look historically. What has the historic return been on the S&P and on bonds? And we'll come up with a balanced portfolio. I think that that's fundamentally flawed at this point because we've looked at 40 years of declining interest rates. And during that period, you've had a lot of leverage that has been put into the system. And that deleveraging goes to really what Marty was talking about. How much leverage has gone into the real estate market over the last 40 years to drive those prices. And now that's being taken away, and rather quickly. So bottom line is you want to be in avoid long duration assets like tech stocks, and you want to be in reflationary assets. Now, another example of how you see
Tyson, can you give a couple of examples of reflationary assets?
Yes, I'll get to that. But basically energy, agriculture, metals and minerals, and then you can just look at individual businesses and see who's able to raise prices and pass those on. Now, Jeff Gunlock, who I think is a brilliant strategist, brought this particular chart to my attention. And again, it's similar to the theme where you had inflation and deflationary sector. And from 1999 to 2008, we had an inflationary cycle. And the way he measures it is the S&P divided by the CRB. So in that period, the CRB divided by the S&P. So during that period, oil went up and the S&P was relatively flat. And then from 2008 downward, it was a deflationary cycle and the S&P took off, but it's been an inflationary environment for energy. Again, this is now flipped, and now we have entered in an inflationary environment. And frankly, everything that's happening with regard to the Ukraine is adding to the inflation, both in terms of energy as well as agriculture. And the reality is we're trying to stop a world war from potentially developing. So it's very hard for the Federal Reserve to blunt, these macro factors. One chart that I had picked up was comparing what I think are great inflationary proxies and technology proxies, and showing their relative outperformance during an inflationary and deflationary period. So from 1999 to 2008, where we had oil prices go up, it was inflationary. And if you owned the XLE, which is the energy ETF, you actually had a return annualized compounded annual growth rate of 22%. At the same time, the triple Qs declined 3%. So your delta in performance between those two sector ETFs was 25%. 25% outperformance in the investment business is enormous. And frankly, I think everybody right now, I kind of giggle every time I watch another Invesco triple Q advertisement about this is the way smart people invest. They buy the triple Q because they're completely upside down, just the way Kathy Wood with ARK is. Now, during the period from 2009 to 2022, tech just took off. Energy only bottomed in 2020, and now it is moving up. But again, during that period of time, the XLE returned 3%, but the Qs returned 20% annualized. So if you were heavy in Qs or tech, you did very well. Again, I'm suggesting you better get out of tech and you should get into reflationary proxies, and energy is an excellent one. So let's look at, when you look at the CRB, oil is the biggest component of it. And what you've seen now is that it clearly bottomed in 2020 in January, when the CRB actually has risen 185% in 2 years. We remember when oil was about $12 at one point, I think in March of 2020. And we remember when oil in the futures market was minus 37. That was the end of the bear market in energy. And now we are on the other side of it. And in our opinion, it's going to go on for years. One way that we have been focused on it is natural gas, which we see as the cleanest source of meaningful energy. Renewables are great, but they don't carry what fossil fuels do. But we have a problem with too much carbon. So owning those assets which give us the most energy with the least pollution was our investment thesis. And we owned one company, Antero Resources, which is up 3,500% in 2 years. The stock went from 1 to 48 in the last 2 years. And it pulled back very sharply during June when we had a reversion trade, and energy sold off very sharply. And we've been buyers of that. It went from 48 down to 31. It's now about 35. But Antero Midstream is about a 10% yield. Same upstream natural gas operator. Another company we like is Tellurian. They're doing LNG exporting. One of the things, finding a stock and actually owning it for your customers that goes from 1 to 48 is tremendous. And what I would say that I got some credit for is that I was looking at it and I noticed they were buying back their stock and their debt, even when Morgan Stanley had a sell on it in 2020 because of a large debt wall. But I knew the management were former Lehman energy investment bankers, and they were actually buying their stock and their debt. And I'm like, there's no way in hell investment bankers are going to be buying back their debt and their stock. But since they're large shareholders, they didn't make too much of it, but that contributed to a 48-fold run. So I actually took it another step and found that there are 29 energy stocks today that are both retiring their debt and their stock. And if you and in an environment where their fundamental asset that they're selling, their product is actually going up in price, that I think makes all the investment logic you could ask for. Other reflationary sectors include agriculture, which is food, but also fertilizer. And there's a MOO agriculture index, and that has broken out, had a pullback here in June. And another area where I think there's great demand is in metals and minerals. And some of those have to do with rare earths and those metals that are going to be necessary for the energy transition. And I applied the same logic again. We have both found companies in these spaces that are retiring their stock and retiring their debt. And I can't think of anything better to be owning. Now, one area, because we have investors who are retired, they want income. Master limited partnerships during that down leg in energy did very poorly. But now they're doing well. You can get 7, 8, 9% yields. And frankly, if you're looking for income in this environment, to get income without interest rate risk or duration risk, MLPs make a lot of sense. I'm going to lastly touch on gold and precious metals. I think that as crypto loses credibility. They lost $1.5 trillion in asset value. And people will go back to the idea that maybe crypto as a digital store of wealth isn't nearly as compelling as gold and silver. I think this will take off. John Paulson, very briefly, was a client of mine. I think he's brilliant. And he had made a very compelling argument that we'll see gold do well because the Fed liquidity that was added in 2008 was used to repair bank balance sheets. But now the bank balance sheets are in good shape. So all this liquidity is going to be inflationary. And I think you're going to start to see, as soon as this Fed stops tightening to avoid a recession, that gold and silver are going to take off. And I suspect those could be 10-year trends. I just point to, I said, this area, this period reminds me of the 1970s, and in the 70s, the Hunts made a great deal of money in the silver market. Now I'm going to introduce Rich Gula, who I've known for 20 years, and said he went to Harvard, studied psychology, undergrad and graduate, worked for Dean LeBaron, one of the first developers of index funds, a billionaire, and also a quantitative investor, and created Battery March, which he sold for about $1 billion. Now he set up the chart room over at Fidelity, worked under Ned Johnson, and that was one of his tasks that he did there. And so he's going to now talk about, I asked him to talk about markets and where there are stresses and things that we should be looking at. Rich, go ahead, talk to us about what we see in the S&P.
Good morning, everyone. The only thing I'll take issue with Tyson's introduction is some random comment at the beginning about being brilliant. And as Tom Brady would say, you're about to throw a pick six in the Super Bowl. And the markets are always right, and the markets are never wrong. It was a lesson I learned from working with Fidelity managers for the past 22 years. Where I've been an independent consultant. But before that, I managed a large international fund in the mid 80s into the late 80s, and then developed Battery March's emerging market funds from scratch, which included going to South America and getting spreadsheets of data and having to convert it into machine readable form and doing true quantitative investing in Argentina, Brazil, Chile, et cetera. The last assignment there was to go to East Berlin and attempt to invest directly in U.S. In the East German companies, which really didn't exist at all. So that project was somewhat short-lived, and then I declined the project management assignment to do Dean's Russian equity fund, since in a long visit to Moscow and St. Petersburg, I discovered that there was no book value because there was no ownership. There was no banking system. It was difficult to decide what the currency really was. And therefore, it seemed to be a somewhat short-lived project.
Rich, let's hit some of these charts.
Yeah, the primary message that I want to give you, 5 thoughts. Number one, since about 2008 and beginning a little sooner than that, stocks really trade as commodities now, much more so than on a valuation band basis, if you will. Number 2, trapdoor declines are going to be part of our life within the business for the foreseeable future. What happened with Target and Netflix are not random examples. They're going to be fairly frequent. Number 3, there's a QE distortion here that is probably even more visible in Europe than it is in the US, but it's clearly there, which takes cyclicality matters and puts them on the shelf for a bit. Number 4, that the Fred database has a critical factor that, and it's seldom looked at, and the Bank for International Settlements will have a lot to say about what happens in the global context, and therefore Christine Lagarde may hold the keys to what happens rather than Powell or anybody in the G7 generally. And last, the Fred database, the most critical chart that I was told to pay attention to many years ago is that of velocity of money. And if velocity is down and negative, the Fed worries about systemic deflation down the road rather than inflation. So you talk inflation and you worry about deflation. What's going on right now? Number one, the R squared, if you will, among equity indices, and I do it through the futures more than I do through the ETFs, is extremely high. You can see in chart. Tyson, how should we do this? Will you move charts as I say yes?
Just say next. We're on the S&P 19.
Yeah, we're on the S&P chart. You can see the low. That there are old timers like myself. I started in the business in 1977, so I can date myself to some degree. There's a cyclic low on the charts in 2020. Whether that's a 4-year low with cyclicality being disguised, if you will, no one knows for sure. But you can see the decline we've had so far visually is a correction rather than a bear market. You'll say, wait a minute, real returns and absolute investors don't look at 25% drops as something inconsequential. But in the context of what we're looking at, I would say that if there's a bear, it's going to be much worse than what we're looking at so far. Next slide, Tyson.
You got it. Nasdaq 100 E-mini futures.
Same pattern. The Nasdaq is just going to give you a beta of about 1.5 or 1.6 to the S&P. Same cyclic low. I'm circling the volume recently because in the world of the futures, somebody's begun to buy into this. That's a combination of stops being taken out when you see the drop of about a month and a half ago. But at current levels, somebody'd like to play the upside. Next chart, please. The Dow is much more muted. So is the same cyclic low in 2020. Next chart, please. And the Russell is showing more activity. You'd have to go through the 2,000 stocks one by one. I've developed for Fidelity managers over the 20 years ways to go through and sift very fast. And the goal usually of that is to find the 20 to 25% attractive stocks. But here's the long-term view of the Russell through the future. And that's a pretty secular up move in equities. I would say that a combination of inflationary data and deflationary worries could drive you back down through that low in 2020. And that would be obviously a very serious matter. Next slide, please. Crude oil, I would argue that as inflation worries increase, crude oil becomes a currency for those that are outside the euro and dollar-based economies. If you're sitting in the Philippines, it's highly likely that you would be happy to have a tanker load full of crude oil and worry about getting some funds for that if you were in really serious situation. Next slide, please. The primary concerns outside of the equity markets, twofold. One is that there are currencies that are at all-time lows against the dollar that aren't really being talked about to the degree they should be, in my opinion anyway. The euro is one. The Swiss franc is normally the haven for chaos. Those of you who may be familiar with Paul Erdman, I urge you to just pick up any of his novels from the 80s. He talked eloquently about how both the Bank for International Settlement and Swiss banks love chaos, and that's where negative rates came from initially. But that breakdown in the Swiss franc says to me that there's a systemic problem. It's not just chaos, because if it was chaos, there should be a rush into those currencies. This is the stress indicator that I've looked at for all the years that I've done international and emerging market investing. Whenever the euro is weak against what should be a stable currency and it's on trend, somebody's exiting the euro massively, and they've been doing it for quite a while. Next slide, please. The question of ARK, is that a saga or a story? If it's a saga, it's going to be right in there with the dot-coms of the 2000 to 2002 era. If it's a story, there's a third of those stocks that are viable. If I were working for Dean LeBaron right now, I'd be sifting through her portfolio as of the peak in 2021, which is highlighted with the arrow there. And I'd be wanting to find anything that looked like it had reasonable business value. And you execute this by equal weighting and not cap weighting your portfolio. You don't know as much as you think you do. Notice an interesting correlation that Kathy Wood's, the destruction of her stocks correlates about 0.9 with the decline in the biotech, the SPDR S&P Biotech Index, which is hardly new companies. There was a massive exiting out of that level of exposure to what you might consider to be unpredictable earning companies beginning back in 2021 that not too many folks talked about. The TLT I present only because this is the beginning of bond market woes for all investors, but especially for absolute return investors. Please go back to that one. During my career, I worked for 5 years at both the Bradley Family Trust in Milwaukee and also the Weyerhaeuser Family Trust in Tacoma. And they were absolute return driven groups. And I was doing either emerging markets or international with each group. So I'm well aware of the fact that negative returns, even if they're relatively strong compared to competitors, are still negative returns. And the TLT is not supposed to be having that kind of a price pattern at this point. But notice when it broke really at the same time. There was a major fracturing in the markets the day after Thanksgiving. And I would, given the group that you have there, Marty, I would hope that folks could discuss this at least privately and say what happened, because a trapdoor was opened that day and it couldn't be all asset allocators deciding simultaneously to sell stocks.
Next slide. We do have lots of questions here, so and you only have about 5 or 10 minutes remaining. So
yeah, I've got only a couple more slides. The MSCI is a classic growth stock for global investors. You can see it peaked at exactly the same time as the market did in that November period. Twitter was sort of a hybrid in that there was a secondary run there that failed. And that was long before Musk began to get involved with the stock. Next slide, please. If I were the other client that I recall having a great time with for many years was the Deere pension plan. Classic defined benefit plans may own these stocks, and I think that they may be saying, where's the bear market? And I realize that it's completely inconsistent with the losses that you see in the averages. But there's a portfolio of utilities plus stocks like Coke and Procter & Gamble that do not reflect the same level of destruction that you see elsewhere. Next slide. The leverage retailers went for a recession beginning back in the middle of 2021, not with the fracturing that began the day after Thanksgiving. So that's going to be Adidas, Dick's, the leverage golf companies and so on. Goldman Sachs has got a bottom and rally if we're going to have a rally. That's the always run Goldman Sachs against the XLF with it not being part of the index. Next slide, please. And the last couple are the real destruction. The worst charts I've seen in ages are the HYG, the JNK, and the AGG. And the last slide, the AGG looks to me like the bond folks that were using this in an asset allocation program sold liquidity first, not quality, or poor quality. That's a terrible, destructive pattern. And I saw a very good presentation about several days ago, an MBS expert who said that most income funds own 2% and 3% mortgages that there are no bids on right now. And last but not least, the emerging markets are actually pretty gentle in their selling so far. So I think that if you were going to have something along the lines of what Tyson was mentioning, there's going to be destruction here. But I'm not totally convinced that that's going to happen. I think that the the minority case here is that the red telephones between Ms. Lagarde and Powell and the G7 are going to be to support prices if we have a real attempt to sell off the markets. Okay, thanks very much.
Questions, guys?
Yes, questions for Tyson. Tyson, it's Pete Thurlow. On the opinion section of today's Wall Street Journal, without getting into politics, it says Biden isn't to blame for inflation. There's a professor that you may know, I'm sure, Mr. Alan Blinder, that was vice chair of the Federal Reserve from 94 to 96. He appeared to blame inflation or the latest increases on Jay Powell missing the timing on rate increases, and then separately just on the war in Ukraine. So can you, I don't know if you saw that article, but can you just provide any comments on that?
Well, I clearly think that the Fed added enormous liquidity from 2009 onward, and somewhere on the Fed balance sheet growing to $10 trillion is they wanted to stave off the financial crisis, and there was a great recession, and then 2020 with COVID, they added about another $5 trillion. So I think that the Fed really went overboard, but you can hardly blame them for wanting to avoid a global decline. But it's too much, and I think that Powell should be criticized, and the monetary authorities should be criticized. But hindsight's always 20/20, and I think that it's not, in my opinion, productive to point to who was wrong. I think the real key is to watch what's happening. In other words, are we going to see inflation start to abate, or is it going to keep on going higher? And I would contend that it'll probably go higher for longer. And Loretta Mester today made the comment, you may have seen, that said that actually the tail on inflation is going to be much higher than we expect, and the Fed is going to have to be a lot tougher. I hope that answers the question.
Do we have other questions here? Yep.
How can we guard ourselves from a black swan event of China going to invade Taiwan?
What's the hedge on China
I think
invading
that's a
Taiwan?
great question, because Rich and I, before this call, said, tell me about the kind of investors. I said, there are probably a lot of kind of private money people in this audience, and they can go to cash. Most of the mandates Gula worked under were, we have to invest somewhere, and cash wasn't an option. I told somebody in December, and wrote it actually in a Seeking Alpha article, it might not be a bad idea to go to 50% cash. But if you're a money manager, most people are going to say, what the hell am I paying you for? But the reality of it is, you want to defend if you're concerned, I think you have abnormally large amounts of cash. I would probably have 40% cash and have some inverses, and periodically, want to buy dips and opportunities, but that also hedges you against a Taiwan invasion. But most people don't think about that. I mean, you can buy defense stocks, but I really think that you have an issue of assets being universally overvalued, except for the commodity complex.
Tyson, another reason to go to cash is that we see a lot of distressed opportunities in the future. So cash might be a good thing to have, right?
Absolutely. And in fact, if you have a lot of cash and then you can go into a distressed opportunity, even in private equity, so you don't have to drive yourself crazy looking at your monthly statement, I think that makes an awful lot of sense.
Any other questions?
Yeah, real quick. It seemed like one of the ways to attack inflation is with the petroleum reserves. I don't understand how the administration can release millions of gallons of oil from the Strategic Petroleum Reserve and then cut back on production, especially with all the challenges around the world related to oil and so on. So I understand there's a very complex arrangement between environmentalists, and I respect all the views, but it seems in a time of national security and global challenges we have, U.S. can clearly push out more oil.
I think this administration is highly political with regard to their agenda, and we all appreciate the idea of the environment and ESG. However, I think you should just look for a real example in Germany. They were all about being ESG. Now they're burning coal, and they were the first to cut nuclear and really push solar and wind. And the reality when faced with war is you need to, the number one UN goal for sustainability is to reduce poverty. And when you have energy prices going up, people get poor, economies suffer, people starve, people die. They are myopic, in my opinion, and they should be open. And draining the reserves is an ill-advised strategy.
Well, one more question, and I've got three. So.
I guess this is for Tyson or either of you. What are your thoughts on uranium?
I like it. I like it a lot, and
Me
you
too.
hear more about that at the ESG panel at 2.
Great. So I have some questions.
Uranium,
Tyson.
look, nuclear is one of the options that has low carbon, but now they're coming out with newer, smaller capacity nuclear, and that's going to be big. It's not fully developed, but in 2 or 3 years, that could really start to come in meaningfully.
Maybe more.
Great. So Rich, on your first slide, you said you had six points you wanted to make. The last one was velocity of money.
Yes.
Okay. Well, last one was velocity of money. And what was the one before that?
Wait, I'm
You had
sorry.
5 points. You had 5 points you wanted to make. The last one was velocity of money. And what was the one prior to that?
Federal database.
QE
Yeah,
dispersion.
nobody, none of the economists you see on CNBC, et cetera, seem to ever look at the Fred database. And yet the keeper of the Fred database is a voting member
Some
of
of
the
the
Fed.
data. Okay. Tyson, gold doesn't, gold doesn't have a coupon and it costs a lot of money to store.
Actually,
Tyson?
there is an answer to that. I own a company called GGN, which is a Gabelli Gold and Natural Resource Fund. It has a 10% yield. It is predominantly in gold and energy assets. And the reason it has a high yield is it is a cover writing vehicle. And I use that along with MLPs to generate substantial income. So
Is that paper gold?
if you want income, there are ways to get income in the gold market, but not buying gold outright.
Tyson, is that paper gold?
No,
It's not physical gold, right?
that's correct. They're gold stocks and energy stocks, and they write options on it to generate significant income. And they've been consistently paying out about a 10% yield, and they pay monthly. GGN symbol.
So you guys talked a little bit about, or a lot about deleveraging, right? But you didn't mention deglobalization. I mean, you have Coca-Cola up there, but I would assume Pepsi would suffer in a deglobalizing world if China and Russia stop buying Pepsi. I mean, it's a real intricate thing that's going on right now. India is getting very inexpensive oil from Russia. I don't know what that means for the whole relationship between India and the United States, but India is a major importer of Pepsi Cola, for example. Any thoughts? Where does deglobalization as policy come into place?
Well, what I would say is with regard to deglobalization is, the U.S. benefited from exporting manufacturing to China and then having Walmart buy all its product and then ship it back and spread it out. And that worked very well for the deflationary trend of the last 30 years. However, now because of the military and economic threats posed by China, that trend of re-onshoring is present and real, and it is an inflationary source. I can't address to whether or not, the implications as it relates to Coke or not, but I do think that it's interesting what Rich Gula said about Coke being a nice defensive equity and probably a safe haven.
You meant,
What would be a trade then for kind of deglobalization?
I don't know. Well, I mean, it's manufacturing in the United States, manufacturing in Mexico.
Mexico, Vietnam, God knows, maybe Africa.
Look at Nike's
But-
exposure in China, right?
But with deglobalization, there's a reduction in demand. Think about it.
That's true.
Which gets to my next point, and my last point, which is that, Rich, you mentioned G7 and Lagarde. So 30 years ago, the G7 was about 70% of the global economy. Today, it's 43%.
That's right. But the G7 may have 80% of the problems. I'm making up a number on the
I
fly.
would say 90,
Maybe 90. That's right.
right?
That's right.
Because Europe has no energy. That's
The-
their
the
real
cru-
mission, right?
Yes, yes.
Oh, I got
Lagarde,
that.
Lagarde is the smartest person in the room almost all the time.
Are you saying that facetiously, or is that true?
No, he
Is
sticks.
that true?
What's that? I'm
Were
sorry.
you, were you being serious about she being the smartest person in the room?
Yeah, I really am.
That's right.
Huh?
The second smartest person in the room is Jim Bullard from the St. Louis Fed. Because he knows the data, and that's the data that they use in their, the only one degree of separation from a famous person I have is that I went to college with Richard Fisher, and I know him pretty well. And he would never tell me anything about what happened when he was on the Fed, but he would always tell me that Jim Bullard was a really smart guy.
Okay, we have a couple more questions.
Go ahead.
So the scenario of catastrophe is being painted here, but what do you think? What do you think Powell's resolve will be to continue the deflationary, to continue pressure in the face of what would happen in the markets and in the economy, given those scenarios? Do you think maybe the Fed would say, okay, our target inflation is no longer 2%, it's now going to be 4% going on?
I get an answer for that.
And why
I
not?
understand the question. Jim Bullard, excuse me, not Jim Bullard, Powell is a political man, and he will do what is necessary. He is tightening now that he was reappointed. And when he starts to see the economy get into trouble, which I expect to be in 3 to 4 months, he will back off. In fact, I've already seen data to suggest that the Federal Reserve is not draining reserves as indicated at this point, and in fact, adding modestly. I think that they really want to stabilize the market, and basically the disaster I'm painting is not a crash, but I think it's a slow bleed. It's an unfortunate kind of economic cancer.
Well, I mean, Tyson, I think it's worse because so many people, I mean, the whole baby boom generation is moving into retirement and fixed income, right?
Absolutely, and that's why you need to have an entire, I think about fundamental factors deciding asset prices. And for 40 years, you've had interest rates, and the history has been for them to go down. And it's all built into all the modeling. That's why 60-40 is what is the de facto standard. And frankly, it is upside down. I would not have 40% into bonds for anybody that I cared about. And I would think that what you want to have is cash and, high yield vehicles, things that are probably like GGM and MLPs, and a very significant portion of cash. That is a far distance from what people have made careers on and raised trillions of dollars behind. And that is the headwind. Rich Gula had spoken about working for Dean LeBaron, this brilliant quant. And I met him 4 years ago. He said, I think the greatest short is the S&P. Everybody now owns it. It is way over-owned. He was a little early, but his observation was dead right. I think you could probably short it for the next 8 years and risk little. I don't think it's but I think that the idea that you're making money in the S&P and bonds particularly is problematic.
If I could add one thought that comes from all the one last thought, which is that risk is the amount of money you can lose and replace. It has nothing to do with quantitative levels. And that's a demographic factor. It's more difficult for those that are, let's say, over 60. And it could be more difficult for a family office that doesn't have unlimited resources to sell or to raise. But the kids have the ability to go out and make more money. And there's an excellent chance that the new economy that is Kathy Wood's bailiwick may have more staying power than I'd like to believe. I just hope Beyond Meat goes bankrupt. So I'll leave it at that.
I think we have one last question, and the answer must be 30 seconds or shorter.
What are your thoughts on hydrogen?
Again, up to the 2 o'clock panel, hydrogen, I think, is a very viable alternative. They have to bring the price down for it to be more competitive. They're not there, but they should be able to scale into it.
Okay, Ron Tabari has a question. You must answer in
No,
15
no,
seconds or
no,
less.
no.
Okay, I'm sorry. Listen, guys,
Just look at H2 Pro, it's a green hydrogen company.
fantastic. Listen, eye-opening discussion. I circulated the document. It's been downloaded 20 times already, and we'll circulate it to the whole registrant list in a couple of days. So I'm sure you're gonna get a lot of downloads. We'll make this video available in 1 to 2 weeks. So very thought-provoking, Tyson. Thanks so much.